You may have heard that mortgage rates are a little bumpy right now, and a lot of it ties to what's happening overseas. Tensions in Iran have been pushing oil prices higher. Brent crude recently moved above $110 a barrel, while U.S. oil, WTI, hasn't jumped quite as much yet, but it often follows. When oil prices rise, it can feed into higher inflation, and that usually puts upward pressure on interest rates. The Federal Reserve met this week, and they decided to keep their rate the same for now. In their comments, they mentioned the uncertainty in the Middle East is something they're watching closely because of its potential impact on inflation. Interestingly, we also saw a very weak February jobs report showing about 92,000 job losses. Normally, weaker data can help ease rate pressure, but Fed Chair Jerome Powell didn't focus much on that. He's still concerned that inflation hasn't made enough progress over the last few months. The Fed's dot plot, which is basically a survey of Fed officials about where they think rates are headed, still shows at least one rate cut this year and maybe two. The catch? Well, they'll likely wait until inflation cools off, and that means we probably need to see oil prices calm down first. In the meantime, rates are still not terribly bad, but we're not going to see much improvement until all of this settles down. Be sure to follow me so you can learn more about what mortgage rates are doing and why. And I'll talk to you soon.